Morning, everybody. We'll officially kick off the retirement plan. Oh, there it is. Now we're being recorded. Thanks, Kelsey. Kick off the September 5th retirement plan subcommittee. We all have the minutes in our packet. Any questions, amendments, deletions, changes? No. All right, those will stand. Let's get right to it. So the pension plan and OPEB updates.
Thanks. Good morning, everyone. Good to see folks. And with the acting chair's directive here, we'll be quick to the chase and hit the highlights. Great to see folks, and I'll get started here, and then Paige and Tyler will pick up on the DC review. Two housekeeping things, less than 15 seconds. If anyone's inclined, our investor conference is up at the end of the month. We'd love to have folks up there. Let us know. We're happy to get you more details. We've got a good couple of days, we think, scheduled. We did announce as well that we have hired a new CEO. I think, as you all remember, we've talked in the past about how we've grown as an organization through time, and we had a little bit of a player coach model where people were doing a little bit of everything. We're at a size now and a scale and from a strategic standpoint where we need dedicated leadership, and Sabrina comes with a wealth of experience in the institutional investment arena, and we're delighted to have her aboard. So that is housekeeping. I'm not going to linger here in terms of what's going on. It has been a productive first 6 months of the year, as you see here on the top of page 7. Both fixed income and equity returns have been pretty solid. Markets continue to get their bearings around the Fed rate hike campaign. We think we're toward the end of that. Lo and behold, it looks like we might actually get a slowdown in the reduction in inflation that they've been targeting, perhaps without an outright economic recession, or a mild one, if at all. And markets have responded in kind. So you do see there pretty healthy equity and fixed income returns. And obviously that's a nice relief from what was a very difficult 2022, as you all know and remember. I'm going to jump right in here from a governance standpoint, two quick things. This is the quarter, you'll remember, on the pension side when we just reaffirmed the investment policy statements. You see a visual here on page 19, just in terms of what we think are important working components of said document. Your current document fulfills all those obligations and meets all those criteria. So we think it's in good working order. Don't have any recommendations for the committee. We did include copies just in case, but let me pause there actually for a minute and ask the chair or the members. I'm trying to remember in the past whether we simply reaffirm the policy statement if you're in agreement, or we actually took a vote, now that I think about it. I think in the past we've simply reaffirmed the document. Lisa, you might have a better recollection than I as a veteran of this committee, but I think that's how we've handled it.
I think the subcommittee has reaffirmed, and then the Board of Finance adopts. So we'll be happy to put that on our next agenda.
So yeah. Great.
Yeah, I agree with that. This body has no actual authority. It's all through the Board of Finance. So, yep.
But we'll ask Amy to put that on our next agenda and go ahead and reaffirm it publicly so the public has notice.
Super. Yep. Thanks, Lisa.
Right. Thank you, Lisa. That's a good reminder. Bear with me here and here we go. And then the other thing from a governance standpoint, again, we're not going to go through all this in the interest of time here, but in terms of good practices from our standpoint, the town continues to the committee fulfill its obligations, right? A good diversified group of folks who have good understanding of the workings of plans and markets, meeting regularly, taking minutes, documenting things. We just talked about the IPS and whatnot. So from a governance and an oversight standpoint, we do think that you are abiding with our a sense of best practices and don't have any concerns or recommendations there. So that is governance. Bear with me here for just a second. Oh, this was actually something. This is more of an FYI. We're working with town management on this, but there was a directive from the state to collect certain information around pension plans, municipal pension plans, and we've been working with Amy and Kelsey on that and getting that information aggregated. Again, there's nothing here from the committee standpoint other than an awareness that the state is in the midst of gathering some information at the municipal level.
Can you speak to what they're gathering, and can we get a copy of what you provide to the state?
Yeah, so that you see here, it's partially us, Lisa. So they are looking to get just, I think, a sense of what towns and municipalities are doing from an allocation standpoint, a fee standpoint, to the extent that they have a working policy statement. Looking for a copy of that. You see here on the list in the middle of the page some of the requests around actuarial information and whatnot. So it is an information grab by the state controller's office. There's not a perfect sense of what their ultimate grand designs on that are. I think, as you all know, the state does administer a MERS, which is a plan for local municipalities to participate in. Bluntly, but between all of us on the screen here, it has not been a particularly successful effort. And I think they're trying to figure out ways maybe to make improvements to that plan or changes to it, and just trying to get a sense of what other municipalities are doing statewide.
I mean,
But
perhaps if they stopped offering benefits that were in the 70s and haven't conformed to the current times, that might help. But yeah,
exactly, Sean. So this came out of the controller's office about a month ago. So we can certainly get you what we've been sharing with Amy and Kelsey.
I do find it interesting. I mean, I know we're not subject to ERISA, but I mean, generally, pension is at the federal level, not the state level. So it is interesting. The state's getting involved, but we can figure more out there. Okay.
All right, so now quickly updates on the plans. So you see, as mentioned, it's been a pretty productive quarter for performance. So you see there, we've got the plans up about 7% year to date, and a little north of 7% over the last year ending in June. And then you see kind of the longer string of numbers there, and no concerns on the performance front. Kind of a couple of interesting things just to point out. You see here, this is town, upper right-hand corner of the page, about $640,000 of gains logged in Q2, $27.4 million. From an allocation perspective, in pretty good working orders. You see here, as you all know, we work with the finance office on contributions and sourcing and keeping us on par with the existing strategic allocation, so the fluctuations are small. So no concerns from an allocation standpoint. I will note for the record, it's not here in performance yet because it was just delivered, but we have elevated MetWest to watch. See there, one of your fixed income managers in your pension programs there. They have some changes to the portfolio management team that they're navigating, and our research team is spending a good deal of time over the next several weeks kind of unpacking that. We'll obviously keep you posted. No actions deemed necessary immediately, but we are working on that. Board of Ed, right? Sharing the allocation, sharing the manager roster. Your results obviously are similar, if not, identical. And you see performance there again up a little north of 7% year to date, and the other numbers longer term as well, kind of ticking along with broad market activities. Allocations here in pretty good working order as well, with no recommendations for the committee. And then finally, police. You see again similar results, right upper left hand corner of the page, up about 7% calendar year to date through June. And the longer numbers kind of chugging along with broad markets. Allocations are in good working order as well. It's interesting, right? So one thing I would note for the committee, we had calendar years 19, 20, 21. You see here, actually relative to benchmark, pretty solid, right? I'm using the town plan here. This is actually total. This is all three plans aggregated. So you see 19, 22, 2021, pretty good, a little bit of a relative shortfall in 2022. So we've had a little bit of a relative softening of numbers, but not dramatic, that draw great concern to us. And again, I think you're in pretty good shape, and the managers are kind of doing as advertised. So no particular concern there, but I wanted to give you a little bit of that intermediate term perspective.
Chris, I appreciate that. Just quickly, any questions from the members on what we just went through? Anything folks want to dive deeper on?
I have a question.
Sure.
Looking at, our allocations, I think they look good. I'm just wondering, like, I know that it's a small percent that we're allocated in real estate, but with the impending, kind of looming issues in the commercial real estate market, is there any concern out there with what could happen if that section really implodes in the next year or two?
You know what, Amber, it's a good question. It's a fair one. And I'm going to send our research team and our research analysts in particular who focus on real estate have done a ton of work there. When you look under the hood away from some of the headline risk, which is centered on office properties, you look into industrial properties and storage and certain multifamily, it's a very different story and one that maybe isn't quite as discouraging. I'm going to make a note. We actually wrote a paper on that gives you a little more detail, but it's the summary there. Barings, I think the manager you have, all things equal, is pretty conservative, and conservative not only in the build out of their portfolios, but also in being pretty aggressive with acknowledging value, and writing down where they need to and not trying to, play that game. So I think that all things equal, it's going to be a tough grind here for several quarters for sure. But I think if you look at the diversity of their program and then the discipline around their underwriting, you should be able to navigate that pretty good. But I'll make a note. I want to send you that paper. I think you'll find it an interesting read. And it sheds light on things maybe not being quite as dire as the headline suggests.
Okay, great. Thank you. I just want to make sure that that's on our radar and we're looking at our exposure there.
It is for sure.
I had a quick question just on cash. As we manage cash, what kind of returns are we getting? Obviously, we have to make payouts. Where is that?
Yeah, so you are in, Lisa, All Springs government money market funds. So those are yielding today, 5% or thereabouts. So your cash is actually very appealing from a yield standpoint right now.
Thanks.
Perfect. Thank you.
Mr. Chairman, the only other thing I had quickly was just OPEB. I can do that in 30 seconds and then give the remaining time to Tyler and to Paige.
Sounds good. Thanks.
So I'm just going to jump ahead quickly here through our materials and just get folks. So OPEB. So there's OPEB. You see here, upper left-hand corner of the page. Remember, the allocations here are a little bit different than the legacy pension plans, but you do see returns there. A good calendar year to date, up 8.6%, almost $630,000 of gains. And remember, we're using all ETFs, indexed ETFs here on this strategy. And you're in pretty good working order again there from an allocation standpoint and from what the managers are doing there. So no concerns or issues on the OPEB. So with that, that's the quick update. And I think we're at 8:13. So I'll shut my mouth and cede the floor to the DC folks, if that's okay.
Chris, beautiful as always. Thank you so much. And again, if there's additional questions that folks have, please do ask them, or we can connect with Chris afterwards. All right.
Great, everyone.
Morning.
I will share my screen here and we will move fairly efficiently through this. Just a reminder, second quarter is our, it says investment focus, but we're always reviewing the investments, of course. This is when we take a deeper dive into, because this is participant directed, do we have the right types of investment options to offer to plan participants? What is the industry looking like? And of course, because we do have a default fund, which is the target date funds, how do they look? How do they perform? And is the committee comfortable with how that works? So with that, I'm going to pass to Paige, and we'll move through that, and then I'll cover the performance of the funds, if that works.
Awesome. Thank you, Tyler. So all funds are unmaintained, so there's no decisions or recommendations for today, just kind of looking under the hood. So on this page, we have the gap analysis, and we use this to illustrate your investment offerings. We're showing the number of participants invested in each fund. As you can see, your plan is pretty healthy, we have all the major asset classes covered. We have indexing and active management throughout each asset class. You have your QDIA, as Tyler mentioned, and managed account service with the participant utilization as well. It comes to no surprise that the majority of your participants are in the target date fund, your QDIA option. But as you can see, your participants are utilizing each fund appropriately across the portfolio. So no recommendations there. We do have some benchmarking on the next page. We've included benchmarking from Vanguard How America Saves survey, and we've listed the asset classes with the percent of plans offering and the percent of participants using it when it's offered in the plan. And as you can see, your plan offers the most utilized and offered investments and asset classes in this survey. And just want to note that 95% of all plans offer target date funds, and 82% of participants utilize it when it's offered. So certainly a popular option among participants in your plan as well as your peers. So it seems as though your plan is certainly in line with industry practices. If we wanted to skip ahead to the QDIA analysis, this is just, an important part of your lineup, garners the majority of the assets. We have the T. Rowe Price fact sheet here, which we show every quarter. Just want to keep you all abreast of what's going on with this fund. They just recently added this year a hedge equity and dynamic credit strategies as an underlying investment options to help reduce volatility from the major market shocks. So just wanted to keep us abreast of that. But there's a couple of the things that we like about them. They're predominantly active. Through this strategy, investors have exposure to TIPS, real estate, commodities, emerging markets, and high yield bonds. These are dedicated strategies that aren't offered in your plan specifically, but you get exposure through your target date funds. And then lastly, their focus is on reducing volatility and long-term growth. And so we have on the next page the strategic glide path. You have the T. Rowe Price funds in red, average top three glide paths in the dark blue, and then the black and the benchmark in the black. The gray line following that benchmark and the glide path are all the suites in the target date fund universe. As you can see, T. Rowe Price starts out at 98% equity, a little bit more aggressive than their peers in the benchmark, and then drop down to about 55% at retirement, and even a little bit more conservative at 41%, but still not as conservative as their peers and benchmark, which has paid off well for them. On the next chart, we have, the 5-year risk reward. So you can see the risk reward profiles of a few vintages on this page, then the scatter plot of all the other suites in the target date universe. And you can see that they're taking on more risks in 2050 fund versus, let's say, a 2020 fund, which giving them a greater expected return. And you can see that they're beating out a good chunk of their peers, about 90 to 90% of their peers in each vintage. Tyler will talk to us about how the funds performed this quarter, but just a quick preview, they were the top of their peers this quarter, so we're certainly still comfortable with this suite being your QDIA option. Any questions? All right, so we can skip.
I don't do others, Paige. Sorry. Anyone? Okay, thanks, Paige.
No problem. If we can move ahead to the stable value, thank you. If we can stay on that page. So just a quick reminder that during periods of rising interest rates, shorter maturities held in money markets tend to reflect a higher market yield. So this is due to the yield curve being inverted, the Fed's pushing short-term rates higher with their rate campaign. So this is making stable values seem less attractive, but we find this to be temporary given their exposure to longer duration assets, and stable values tend to outperform money market over the long term. If we can move ahead to the next one. And so we've included your fact sheet on your stable value. It's, definitely something that, we can look under the hood. We have, the 12-month put, which is, the plan sponsor needs to give 12-month notice before exiting the fund, and it's meant to protect the fund's remaining investors and wrap issuers. We have the market to book. The market to book ratio has fell below 100%, but still in line with the universe median. And this was due to the high interest rate environment that we're currently in. So no concerns on that. And you can see that it's trending up back towards 100% at this point. On the next slide, we have the crediting rate. It is also in line with the universe median. So no concerns there. You can see that even from a year ago or even 2 years ago, still in a better position than where we were. And then so we have the wrap providers, their credit quality. You can see that they're diverse and highly rated. So no concerns on your stable value and, you know, still being comfortable as your capital preservation option. Any questions before I pass it to Tyler?
None for me. Anyone else?
Okay, great.
Paige, thank you for that review.
Thanks, Paige. Obviously balance is up from end of September, so up to close to about 15 million on the 457 plan, and for the board ed plan coming up to about 1.3. So, you know, combination of assets, contributions, as well as performance. Bulk of the assets actually in three funds, the S&P 500, which is pretty typical that we see, stable value, and then target date funds, which represent, you know, roughly 17-18% of the assets. Similar story for the Board of Ed plan, and actually a little bit more weighting, given this is the newer plan in the 401A plan, about 87%. You know, obviously newer, more folks in default, and therefore more people in that target date funds. As Paige mentioned, you know, she talked about risk and reward, but you can see the performance has been very positive for the T. Rowe Price target date funds. You know, top decile, top performing fund, pretty much in all vintages. We obviously have that net of fees and have a maintained status on all of those funds. You know, looking at the core menu, longer term, still outperforming. You know, index, we're not as concerned as peer performance, because obviously we include active manage in that. But the active managers are doing fairly well. No recommendations to change anything today. You know, there's some noise a little bit in the growth stock fund. We had a long conversation with Joe Fath, who's the PM there in Baltimore, and are fairly comfortable with their risk controls and benefited from our patients over the last year or so. So I'll pause there, see if there's any questions around performance. No proposed voting items or recommendations for this group, and
I'll open up. Any members have any questions? Things we want to go deeper on? All right, Tyler, keep going.
that's all I had.
Oh, all right. Thank you. All right. Any other questions or items that the members wanted to bring up? Kelsey, anything from the finance office?
No updates from us. And Lisa, I can reach out to Tom Fitzgerald. He's the one that submitted that pension reporting for the state, and I can see what he submitted to them and forward it on to you.
Thank you. And Chris, we have on our regular Board of Finance agenda, you report to the full board twice a year, and we have you targeted in September. I just wanted to touch base on that.
Oh,
If
okay.
September doesn't work, we could do that in October.
Yeah, I just, do you remember the date, Lisa?
No, we can follow up with you. I just want to put it on your radar.
Okay, we can coordinate. Tyler and I can coordinate as well.
Perfect.
All right, we'll have that as a takeaway. And then obviously if there's any items, Lisa, I'm sure you can coordinate getting those to Chris and Tyler ahead of time.
Absolutely.
Okay. Is there anything else we would want on the agenda for this subcommittee next time? Anything coming down the pipe that we would need to start thinking about, Tyler, Chris, or the members?
Sean, this is Lee Erdman. Sorry,
Hey, Lee.
I joined late, but good morning, everyone. I do have one question, and that is, do we have a long-term plan to get to at least 80% funding, if not 100% funding over time?
I mean, I believe we do. And I mean, we have been there, right? We've been subject to market fluctuations and planned structural changes, but.
Right.
Yeah, Lee, I'll just add to that. We do follow our actuary recommendations, have always met their recommendations for full funding. So we do follow that. At times when there is excess cash in the general fund reserve, sometimes we put those towards an additional payment towards either retirement or health. Lately,
Very
they've been
good.
going towards capital because there's been a tremendous capital need, but that is certainly one of the considerations we evaluate at the end, at year end.
Great. Thank you very much. I appreciate that.
No, it's a good question. And obviously Lisa and the other members, we always ask about liquidity in it as well, right? And Chris in particular gives us good advice on where we have years where we might need to pay attention to more liquidity or not. So I think, overall, I think we've got a stable track record. We obviously want to see, more of those returns creeping up to our expectation, but there's been a lot of analysis done, I would say, right, at least in the last 10 years on proactively managing our obligations. And again,
Also, our funding level looks like it's gone down, but it's actually because of the new assumption we've adopted, which is the 6.5. So that made it appear that we have less money. The actual money is the same, but we're using a more conservative assumption rate based on the recommendations of our actuary.
Right, which is good. Conservative is good.
right. And I believe we're one of, if not the only town that's nearly fully funded in our OPEB obligations in the state of Connecticut. So we, as you probably heard on the bond rating call recently, Leah, the rating agencies continue to be, I think, impressed with our proactive nature in that space as well.
Yes, absolutely. That's outstanding.
Yep. All right. Any other questions for the good of the order this morning? All right. I bid you a wonderful short week. I hope everybody had a wonderful long weekend, and I look forward to seeing you all again at our next meeting. We are adjourned.